Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 314 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including tariffs and the retail sector, stock valuations, seasonality of the VIX or the volatility index, credit spreads, and an update on a few economic indicators. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. So let's jump right in. Good morning, Matt.
Good morning, Mark.
Big week in the McEvely household. Mia turns 2 on Sunday, so we're having her second birthday party this weekend with some family and some friends that are coming into town. So time flies.
Time does fly. I feel like she was just born yesterday.
Yeah, I know. It's crazy. So she's doing great. We got a bunch of gifts headed her way, so hopefully it'll be a fun weekend.
Oh, you'll have so much fun.
Yeah, it'll be good.
I'm excited for you.
Well, moving right along, as always, we will take a minute to go through the major indices that we track for listeners. These numbers are from Y-Charts and as of the market close on August 20th. S&P 500 index up 0.9% so far for the month and up 8.7% for the year. The Dow Jones Industrial Average up 1.8% for August and up 5.6% for the year. The NASDAQ Composite Index up 0.2% for the month and up 9.6% for the year. The Russell 2000 Small Cap Index up 2.7% for the month and up 2% for the year. And the Vanguard All World X United States ETF is up 4.4% in August and up 21.1% for the year. 3-month Treasury rate at 4.3%, the 2-year Treasury rate at 3.74%, 10-year Treasury rate sitting at 4.29%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Moving on to big headlines, current events from the past week, Matt. This was just announced yesterday, but Vanguard is recommending investors tilt heavily towards bonds with a 70% allocation to fixed income and 30% to stocks, as high stock valuations point to better longer-term returns in the bond market, according to Vanguard. So just wanted to get your initial opinion on this. I think I know what your response is going to be, but I think the listeners would enjoy your stance on this.
You know, what really starts to grind my gears is people are attempting to utilize historical valuation metrics now on a currency where the money supply has been increased by 50% in the last 5 years. So when someone looks at me and says, Matt, XYZ Mag 7 stock is trading at a 23 times PE, it ain't worth it. And I'm like, okay, you're valuing it on a currency that had its money supply increased by 50%. So the value's decreased. You can't, in my opinion, that's where I think the market's falling short on this. And I think it's easy. This is going to sound, I don't know how this is going to sound. I'll just say it. I think it's an easy call to say bonds are going to do well when we're on the precipice of an interest rate cutting environment, right?
Yeah.
So explain to our listeners and viewers what happens to bond prices in a lowering interest rate environment, just so they get it.
Yeah. So when interest rates come down, bond prices tend to rise because there's that inverse relationship between interest rates and bond prices, right? So, we've seen that a little bit just because the Fed did cut last fall, but really hasn't done anything this year. But again, when bond prices are rising, interest rates are usually falling, and vice versa.
In my additional call here, it'd be like someone yelling for, knowing the tide's going to come in, with most likely rates being lower the next couple of years. Kind of seems to me Vanguard's like, yeah, the tide's coming in, everyone. It's like, yeah, I think that's kind of a general assumption in the market. Going back to equity valuations, I think that's a dangerous conclusion that we are rating valuations based upon a currency that's been devalued so much. I think that's dangerous to make an investment decision based on that.
Yeah, I would agree. And actually, I'm just going to jump right to my...
And no one's talking about that right now, by the way.
No, you haven't heard that. It's the first time I've heard it. So it's a great point. One of the items I had that I wanted to talk about today kind of goes along with this. It was a post on X from Jay Capel back on August 11th. And Jay says, the stuff I follow is still net bullish on stocks, so I am bullish on stocks. That said, valuations suggest it's a good time to invoke Jay's trading maxim number 18. Follow the trend, but do not fall in love with the trend. And it's this graphic, I think from Callum Thomas, who we had on the show several years ago at this point. And it shows that according to these metrics that I'll get to in a second, S&P 500 is the most overvalued in history, going back to the early 1900s, and even it looks like on this chart, the late 1800s. But by combining a bunch of different valuation metrics, let's see, Simon White and Bloomberg came up with this metric that says that stocks are the most overvalued in history. And what they're using is the trailing price to earnings ratio, so just the price of the S&P 500 divided by the earnings, the forward price to earnings ratio, the CAPE ratio, price to book, EV to EBITDA, the Q ratio, and market cap to GDP. And what this shows is several other periods in history where valuations have been approximately this stretched. 1929, 1966, 1999. We all know what happened in those three periods of time. But I think my comment on this is overvaluation can last for a lot longer than people think. And to your point, I think to add to what you said about currency expanding by 50% over the past several years, I don't think that it takes into account the efficiency that companies have today. Things are very different today than they were 70 years ago.
So you're saying you don't subscribe to Jeremy Grantham's peak efficiency model from the late 2000s, that efficiency, there's no way companies can be more
anymore.
There's no way.
It's a tough comparison to make, and I'm the first one to say, I always call out when people say it's different this time. That's not what I'm saying. I'm just saying that I think there's a lot more that needs to be taken into consideration than just looking at a few valuation metrics that are popular amongst people in our industry.
We haven't had in the last 50 plus years, we haven't had a period of time in 5 years where the currency was devalued by 50%. And then people are trying to overlay, metrics of how expensive or cheap something is against that pre-printing metric. This has to be adjusted for inflation for me.
Yeah.
And the money printing. And I got a hot take. I think if you do it, stocks are actually not going to look expensive on a neutral currency basis. I know it could sound like a hot take, but just with so much money being printed the last 5 years, we just have to realize as investors that dollar just doesn't go as far as it used to.
Right. And it won't in the future, right? That's how it works. So,
yep.
Moving on, next point I had was a post on X from Mike Zaccardi back on August 13th. I briefly mentioned this, I think, in last week's podcast, but wanted to share it officially with listeners and viewers. So Mike said, remember empty store shelves this summer?
Oh, yeah.
The XRT Retail ETF is at a 52-week high and the highest point since January of 2022.
How could that be?
Yeah. So I won't, again, I mentioned this a little bit on the previous episode, but just wanted to share this for people that are watching on YouTube. And it just goes to show you another one of those instances where people are like, retail stocks are going to get wrecked. You're not going to be able to buy what you want to buy because all these stores are going to be out of everything. Their inventory is going to be low. Things seem to be just fine. And again, I don't want to pigeonhole myself. That could change over the next couple of months or the next year or two. But for right now, those predictions of, all hell breaking loose, kind of going back to COVID era of supply chain issues and not being able to buy what you wanted to buy, that just hasn't come to fruition yet.
No, not that I have seen either through, my day-to-day or in research.
Yeah. Last thing I had was a post from Jeff Hirsch on August 20th that shows the historical seasonality of the VIX or the volatility index from 1990 through 2024. So Jenna will put this up on the YouTube page. It'll be in our show notes. I've talked about this before earlier this year on the podcast, but typically what we see is throughout any calendar year, volatility tends to be at its lowest point of the year in late July and tends to peak sometime in October.
Correct.
And what does that mean, right? So for newer listeners, the volatility or the VIX index, we use it as a fear gauge in the market. It has a very high inverse correlation to stocks. So when the VIX index is rising, stocks tend to be falling and vice versa.
Yes, sir.
So what I'm saying here is that typically between now and sometime in October, we tend to get a spike in the VIX, which means usually stocks are falling, right?
Yes.
So I just wanted to point this out because we have seen some weakness this week in the markets, and I don't want people to think that this is a something that isn't normal, because typically around this time of the year, we do tend to see volatility rise and stocks sell off a little bit. We've been previewing that for the last several months on this show. We've been previewing it to clients in our monthly newsletters.
Yep.
So it is normal. People should expect it. We've had a very, very strong run in the markets from the low in April. So again, would not surprise us to see some sort of an even larger pullback than what we've gotten so far this week, just based on history alone.
To see kind of the market's reaction, a lot of the talking heads sentiment that I'm seeing, people are acting like the small correction we've had so far is like 2 to 3 times as bad as it is, right? That's a good sign for me. I'm really getting this feeling that under allocation to equities is just still out there. And we'll see if I'm right as the year goes on.
Yeah. Good point. I'll turn it over to you.
My first thing I want to throw out there is an update on credit spreads. And before I get into this topic, I want to use this as an educational time for our listeners and viewers, Mark. When we talk about credit spreads, that is the difference in interest rate between, say, 2 loans or 2 bonds with different risk levels. So the one that we would usually talk about here on the Independent Advisors podcast is the spread between what we would call the risk-free rate, i.e. a U.S. government bond, versus something that's riskier, i.e. an investment-grade corporate bond. So the difference in interest that you would be willing to take on as that investor, because again, U.S. government, risk-free, the corporate bond that's issued has risk. That difference would be what we call the credit spread.
Right, and you get compensated as an investor, if you're, holding a corporate bond that has a risk of defaulting, that rate typically is going to be higher than the risk-free rate of the U.S. government bond, because at least up until this point, the U.S. government hasn't defaulted on their debt, right?
Correct. So one of my favorite kind of canary in the coal mine indicators is you're seeing this rinse and repeat news cycle about the potential for a recession. Yes, there is a potential for recession every morning when I wake up, okay? But the higher this credit spread is an indicator for me that what the risk level is in the market, right? And the credit spreads right now are very, very thin compared to history. We'll have the chart in our show notes. I won't overdo it, but you're just seeing a very, very tight credit spreads compared to history. Just something I want to throw out there. I could make a good argument that a threat of a recession, barring a geopolitical event in the next couple of quarters, is just not there.
Yeah.
Just not there.
Yeah.
Second thing I want to throw out there, I want to get your kind of thoughts on this, is this this chart I ran across from Apollo on August 18th. It overlays FedEx's stock price versus world trade volumes. And this chart goes back about 2 decades, and it's really interesting. You've really seen kind of a fall off recently of some world trade volumes, and FedEx price has not followed. And this is getting some rotations as this, one of those potential leading indicators. And I kind of came up with some positives and negatives. What you're seeing in this chart is there's obviously some clear correlation between the two, right? The chart shows a visible relationship between FedEx's stock price and world trade volume. Both tend to move in the same direction with a slight time lag, making the FedEx a potential early warning signal. It goes back 20 years, including major events like '08, the financial crisis, and COVID. And again, using the 3-month lead on the FedEx stock price helps anticipate global trade. Here's my biggest con with this. Correlation doesn't equal causation. Just because FedEx stock often moves ahead of trade volume doesn't prove it causes changes in trade. Limited context, in my opinion. The chart doesn't explain why FedEx stock price leads, and it's not adjusted for external shocks like COVID and geopolitical tensions. So in case you've seen this chart, Mark, I'd love to have your opinion. My opinion is FedEx stock, using it as a potential early warning signal, should be one of those indicators, but let's not put too much weight in this. Your thoughts?
Yeah, I would agree. It's just, FedEx, and I don't know if this is the case or not, but it could just be in a scenario where FedEx is going through something as a business that has nothing to do with world trade volume.
Exactly.
And that's impacting the stock, right?
Exactly.
So when you're just using, one piece of data and comparing it to the price of one individual stock amongst thousands of them. Yes, FedEx, is probably a pretty decent indicator of economic strength because it's, shipping goods all over the world, right? Sure. But like you said, the correlation doesn't equal causation, and it could be something else that's impacting the FedEx's stock right now.
Now I have something on the whole opposite end of the curve, which was in the same research slide deck from Apollo. So they had U.S. business applications. So this is, in essence, people starting new business entities is just rocketing the last 12 months. So this is not being talked about a lot. Dramatic rise you're going to see in this chart. So, a rise in business application often signals increased economic optimism, entrepreneurial confidence. New businesses can lead to future growth in jobs, innovation, demand. You have, when you look at this, the economic cycles and investor sentiment, business application trends often align with economic cycles. This to me is definitely not bearish by any means when you see the amount of individuals that are being entrepreneurs and opening up businesses. It's pretty shocking when you look at the level of this. What's your thoughts?
Yeah, since really the GFC up until, really 2020, corporation business applications has been pretty much falling almost every year. There's blips, where it's risen just for a short period of time, but since 2020, you've seen this what we call change in trend,
Well said.
where the number of new corporation business applications has more than doubled since 2020. So I think that's a great sign for the economy, and that people are willing to take risks, and they're in a financial position to take risks.
Well said.
So this is another interesting one, because going back to talking about data without context, I think we quote quite a bit on this on this podcast when people come out and say, consumer debt or small business debt is at the highest levels we've ever seen.
Keep going.
Well, if you look at this chart, I don't know many people who can start a business with just cash, right? I would say 98% of people that are starting a business take out some sort of debt or have some sort of debt facility, but that's just part of getting a business going, right? So I think if you throw this chart in there, it gives that debt data conversation a lot more context. Because this is wonderful news.
I'll go one deeper. So looking at the dramatic rise of these business applications, I saw a news article about a tick up in small business bankruptcies, that was the canary in the coal mine for a pending recession.
Right.
And so you are showing the one piece that, yes, bankruptcies on small business level have ticked up, but look at the dramatic rise the last several years in the formation of new businesses.
Right.
It goes,
obviously, you're going to have, when you have more businesses, you will have more defaults.
So again, this is where I want to bring it full circle. I want listeners and viewers to be cautious making long-term investment decisions for their long-term plan based upon some of these headlines. That's my word of wisdom. And that was more apparent back in February, March, and April. Were there some scary headlines, and were there some scary predictions as to how the rest of this year, even up to now, would come to fruition? Absolutely there was. But I can make this argument that those investors that stuck by their plan with a long-term time horizon tend to be more rewarded than the ones that try to time the market on a shorter term basis.
Yeah, beautiful. Yeah, we talk about that all the time here. And I think that's the, if someone was tuning in and wanted to take away something from this show, it is that, not to let these, outside pieces of noise affect your long-term plan.
Well said.
Yeah. Last but not least, moving on to the financial planning topic of the week. This is an article from Health System Tracker by Jared Orteliza, Matt Mago, and Caitlin View, titled "How Much and Why the Affordable Care Act Marketplace Premiums Are Going Up in 2026." This is back on August 6th. So I don't know how many of our listeners are buying health insurance via the Affordable Care Act, but I thought it was interesting nonetheless. So they say for people buying health insurance via the ACA marketplace, premiums are expected to rise significantly in 2026. That's the result of two things. Number one, insurers are proposing a median premium increase of 18%. And number two, enhanced premium subsidies, which have been in place from 2020 up until 2025, are scheduled to expire at the end of this year. The expiration of enhanced tax credits will lead to out-of-pocket premiums for ACA marketplace enrollees increasing by an average of more than 75%. This is the largest rate change insurers have requested since 2018. And why are they requesting these rate changes? Number one, rising healthcare costs. Number two, inflation. Number three, labor costs. And number four, GLP-1 medication and specialty medication coverage. So again, not sure how many people that are listening to this are getting insurance through the Affordable Care Act marketplace, but next year there will be significant premium increase. And I think, this is one of those things where a lot of people don't realize, how much subsidies there are out there, especially in the healthcare industry. And this is a perfect example of that. Those subsidies are ending. And then you have, premiums, possibly increasing, or costs possibly increasing more than 75%.
Yeah. I mean, I think it just has to be a topic that people are aware of and allocate for. I mean, you just continue, if you just look at the lens of history, the last 3-4 decades, it's either higher education or healthcare that just have this drastically above average inflationary rate. And there's a lot of factors that go into it. And then on top of all the reasons that you just mentioned, Mark, you now have a lot of scrutiny, for better or for worse, under the practices that some of these health insurance companies are using to approve or deny certain procedures. And that within itself could raise cost if all of a sudden the insurance companies are feeling more pressure, again, for right or for wrong, to approve more things that come their way. So I definitely would look at it through the lens that if you had to make me bet on this the next, say, 2-3 years, you're probably going to see some sizable jumps in these premiums.
Right.
I mean, at us as a firm with ours, I'm prepared for, that mid double digit hike going into next year based upon everything you're telling me.
Right. Yeah, I know. Every time, we get the premium renewal notice, when it's less than 10%, we're
celebrating,
jumping
baby.
Off the floor.
We're
right?
celebrating
Yeah,
if it's at double digits, right?
Yeah, exactly. So, well, that's all that we had for today, Matt. The one thing I will leave listeners with before I give you a chance to say anything you want, the chances of a Fed rate cut in September have risen significantly since the last Fed meeting. Mm-hmm. And I think that's due to some of the economic information that has come out since then, and then also some of the Fed board governors giving interviews, kind of not telling them exactly what they're going to do, but alluding to the fact that we are getting closer and closer to a rate cut. And you'll see that, in the odds board that we check on a regular basis of what's the percent chance, so to speak, of a Fed rate cut or a rate hike. And those odds of a rate cut in September during their meeting have risen substantially just over the past couple of weeks.
So I'm going to be a forecaster over the next year. And what it immediately makes me think about is that $7.4 trillion that's sitting in money markets that is nice and comfy and cozy, Mark, earning over 4% risk-free. And what happens when someone pulls the blanket away and they start to get cold and that interest rate comes down and it gets more closer to inflation? I can make an argument, not all of it will end up in the stock market, may not even be a significant percentage, but some of it will. So when someone says to me, Matt, where's all this fresh capital going to come from? That's one example. But just I look at it through the lens, I think you're going to see a lot of just movement of money through the financial system as these rates come down. I think it's going to be pretty interesting because a lot of investors haven't really seen, newer investors especially, haven't seen the effects of a lowering interest rate cycle. And I'm excited for it. I'm here for it.
Yeah, well said. I mean, that's what it's designed to do, right? It's to stimulate the economy, stimulate growth, get more money moving throughout the throughout the economy. So, it'll be interesting. I'm not saying that it's a foregone conclusion at this point, but odds have definitely shown that investors are expecting a cut in September and possibly another one before the end of the year. So
I think it's going to be a good thing if they do the first cut. Now remember, I've always said this many times in the podcast. I'll leave you with this: the slower the pace of rate cuts once they start, the better it is for risk assets looking through the lens of history. Right?
Yeah. So we've seen that so far, right?
Yeah, when you see them cut. I don't want to see them cut at that very next meeting.
Yeah.
Right. You want to see some breaks because, I think the economy can, in my personal opinion, can withstand lower rates and have a nice equilibrium with inflation. I just don't want to see them cut every single meeting.
Right. Yep.
Don't want to overheat it.
Yep. That makes sense. Well, thanks everyone for tuning in to episode 314 of the Independent Advisors Podcast. We will be back with you next week.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.